Well, good morning, everyone, and thanks for joining us. My name is Namir Hallak. I'm a U.S. cross-border managing director at Anderson from beautiful Vancouver. And I'm joined today with my colleague and managing director from Calgary, Dale Franco.
Yeah, good morning, everyone. Thanks, Namir. I also am a Canadian CPA, US CPA. I've been in the cross-border business for many years, dealing with corporate structuring, planning, immigration. Not that I'm a lawyer, but I have an understanding of immigration and what kind of structure we need to be implementing, and also Canadian and US tax compliance. Not that I do the returns, but I review them. So thanks, Namir.
Thank you, Dale. And hey, look, I'm really excited to share this next hour with you, Dale. This is a topic that has actually come up after a roundtable with the other managing directors a few weeks ago. And we were trying to answer the question of, why does now feel a bit like a different moment for Canadian companies looking at the US? And really, if you step back the last year and a half or so, it seems like the entire cross-border landscape has changed quite a bit. You've got a more aggressive or, let's say a more attractive U.S. tax environment post OB3, which is the new U.S. legislation that was passed last July 4th. We've got some supply chain reshoring, and even a lot of our client base, both for me and Dale, we're seeing a lot of capital and IP flowing into the U.S., especially in the tech space, in AI and manufacturing, which is a lot of what the OB3 was meant to attract. OB3 is the legislation in the US that was passed last July 4th. So a lot of Canadian businesses are asking, do we need to be in the US to grow? I think 2 years ago, they were considering US growth, whereas now they're really looking at how do we model entry into the US. So some of it is reacting to tariffs. Some of it is, still chasing after US customers, but increasingly in tech, they're really following the capital and the talent density in the US. So hopefully in today's session, it's not just to give you how the rules work, but how is this actually shaping decisions for Canadians? Because going to the US, it's a big decision, and if you get the tax wrong, it can become a pretty expensive mistake.
And
Um,
just to
so
clarify for everybody out there, OB3 is one big, beautiful bill, but Namir prefers to use the acronym OB3. And you're right about Canadians expanding into the US. I had a client last week reach out to me and saying, he has a product that he wants to expand into the US because the US economy is far bigger than the Canadian economy. And because this product also is manufactured, he felt that he could get it manufactured in the US to avoid tariffs and try and reduce his costs. And then also, we had a conversation about what's your exit strategy, which he was completely surprised by. And he said, "What do you mean?" I said, "Well, you're starting this business in the US. What do you want to do with it? How are you going to get out of it?" So we talked about IPO, we talked about private equity, but then I said, generally what happens with private corporations is you're looking at a strategic purchaser. And the strategic purchaser likely would be in the US when you're dealing with US manufactured products. So it makes sense to expand into the US and then also have your intellectual property located within the right entity in the event that a strategic purchaser comes along.
Now, before we jump into that, Dale, so that's actually why this is a hot topic for us. I just do want to do a quick housekeeping rules. Up in there. So, as a NASBA accredited sponsor, we are able to offer continuing professional education CPE credits for today's webinar. In order to qualify, you do need to answer all three polling questions that will appear during the 15-minute session. These will pop up at various times throughout the webinar. So please do make sure you are tuned and respond promptly to each of the questions. We do encourage you to ask questions throughout the webinar using the Q&A function. While we may not be able to address all the questions immediately, we have set aside about 10 to 15 minutes at the end of the session to go through as many as we can, and we really do welcome your engagement. Once the webinar does end, you will see a short survey that will automatically pop up. We would greatly appreciate if you could take a moment to complete it. Your feedback does really help us improve future webinars and continue to bring relevant, valuable content to you. One other note, if you look on the bottom of the screen there, you'll see you can enable also the closed captioning. So simply click on the live transcript button at the bottom of your Zoom window and select Show Subtitles. This can be helpful if you're in a noisy environment or just prefer to follow along with text. And with that, Dale, maybe if you want to walk us through the agenda here.
So we have five different topics that we want to chat about today. The first is taxation of a cross-border business. What that looks like, how does that happen? The second is taxation of Canadian individuals in the U.S. So that's from a tax perspective. And we'll also talk briefly about immigration because you cannot work in the U.S. unless you are lawfully permitted to do so through a visa or a green card or something like that. The third topic would be cross-border entity structure options. And this is really important when you're structuring your business because it has to make sense from a repatriation strategy. It has to make sense from an immigration strategy if you're wanting to move Canadian employees to the US to work in the US. And it has to also deal with proper alignment and the ability to claim foreign tax credits. And one of the things that we'll be highlighting on is US LLCs, limited liability companies, not corporations, but companies. The fourth thing we're going to chat about is repatriating US profits back to Canada. What's the best way to do that? How should it be done? And then the fifth thing will be just touching on US taxation, state taxation, excuse me, from a point of view of nexus, physical nexus, economic nexus, and other US state tax issues.
Excellent. Thanks for that, Dale. And well, let's get this grounded in a real scenario. And you're expanding your business into the US. And in one scenario where we're seeing a lot of this is in the tech sector. So we'll try to weave in some examples that we have, real life examples from some clients that are in the tech sector. So, for example, if you've got a Canadian software as a service company, they come to us and they'll say, "Hey, you know what? We're starting to pick up some U.S. customers. We don't necessarily have a U.S. entity yet. We're really just testing the market. At what point for a Canadian company does this become a U.S. tax issue?" And that question, it happens earlier than most Canadians expect. When are you actually doing business in the US? So that very first entry point, it's actually a pretty low threshold in terms of what does it actually mean to be doing business in the US. And from a US perspective, that entry point isn't incorporation. So it isn't necessarily, it isn't, oh, I actually have an entity set up in the US, so therefore I'm doing business in the US. It's actually centered more around what is your US activity. So if you have, and this is again a very common scenario we see with a lot of our clients as they're marching towards, having a full US trader business, is, first you've got a Canadian founder who is, flying naturally into the US to hopefully close deals. Maybe they're going down there to do some contracts or negotiate with U.S. customers, or they're just picking up a revenue. They have revenue from U.S. customers that's tied to the U.S. market, but it's not a one-off. It's starting to become more of a recurring revenue. That's where you're not necessarily testing the waters. You're actually participating in the U.S. You have what is known as a U.S. trade or business. Now, the concept of a U.S. trader business, that's not a bright line rule. It's more a question of, facts and circumstances. Is there enough presence for your Canadian entity that, you're regularly and continually, doing what looks like a business that's operating in the U.S. So let's, if you're thinking again about that from a software as a service company, or if you're looking at it from a tech company, it's looking at your sales activity. It's looking at it throughout the year. It's looking at, for example, what type of customer support do you have for those U.S. contacts? I don't think, we tell clients, it's not that you wake up one day and you say, oh, okay, I woke up today and I have a U.S. trader business. You often drift into that as your U.S. activity scales. So I'd say stop one would be, okay, do I have a US trader business? Am I doing business in the US? That's stop one. Stop two is looking at, okay, well, once you know that you're engaged in a US trader business, the next question we have with our clients is, well, what of that income can the IRS actually tax? And this comes down to two different tax concepts. One is what's known as sourcing. So, what is the source of that income? Is it Canadian source income? Is it US source? It could be other jurisdictions. And is it effectively connected income? So, let's get a little bit more nuance to this and think about it from a software as a service company. So, for a software as a service company, you've got cloud transactions happening. It's on-demand network access to, let's say, a computer hardware, or it could be digital content. So how do you source that income? So sourcing that income previously used to say, well, this could be where our servers are. But that's actually there's proposed regulations that came out, I want to say January of 2025, so a year ago, a little over a year ago, that gave a little more clarity here for cloud transactions. How do you source that income? And instead, what they're looking at is not necessarily where the revenue is or where the server is located. They're looking at the overall activity. What activity did you have that actually generated that revenue? So if you're running it's a Canadian corporate entity, it's a software as a service company. Your servers are in Canada. You've got these software developers, software engineers, and they're in Toronto. Well, the scenario is, well, I've got U.S. enterprise customers. Great, that's what we want. We want to access that bigger market in the U.S. Um, but now you're looking at what is the activity that you're doing to generate that revenue. If you have your sales leads that are flying to New York twice to close a deal, do you have contracts that are being negotiated with U.S.-based executives? Or maybe, after you sign the contract, you've got a customer success team or support team that's sitting in Vancouver that are running weekly onboarding calls with that US client. Your support team is actively solving issues for a US customer, even if they're doing remotely. They're not in the US, but they're doing this activity that's really starting to create US source income. So a lot of these sales efforts are economically tied to the US. Well, then we say, you are really getting to this space where you have US source income. So then the next question is, well, is that income effectively connected to your US trader business, your US activity? And if it is, then we get into that concept of effectively connected income, ECI, and that's what get taxed in the US from a domestic law perspective on a net basis. So the proposed regulations that came out on cloud transactions, it's really, if you think about it, it's the IRS trying to catch up with how fast this space is moving. How do I characterize this income and where do we source this income? Because you can rely on outdated rules, where you say, well, if the services are performed entirely in Canada, then the source of the income must be in Canada. Well, that probably worked out great, but not so much when you're in a space where you have things happening over the cloud. So with that, the concept that I want you to walk away here as kind of your first two questions is, remember that the US trader business threshold for having a US trader business is actually very low. You have executives traveling to the US, employees traveling to the US. So if you have a US trader business, you have a US filing obligation. But the next step of that is, if you have the US-Canada treaty and you're protected by the US-Canada treaty, what that does is it offers you more protections. It doesn't remove that exposure. You still have a US trader business. The US can still say you have a filing obligation. But what that means with the US-Canada treaty is you're looking at the concept of permanent establishment. And what permanent establishment means is, under the US-Canada treaty, business profits are generally only taxable in the US if you have a US permanent establishment. And that's a higher threshold. So here you're looking at things of, do I have a fixed place of business? Do I have an employee, or we call a dependent agent, going to the US who is, signing and concluding on contracts in the US? Are they negotiating with clients, rejecting or accepting their creditworthiness based on the history of the client? Or, in a consulting or, services type business, you have what's known as services PE. So if you have employees, Canadian employees, that are, going down to the US and they're spending a sufficient amount of time in the US, generally about 183 days in a 12-month period. Even if you don't actually have a fixed office, a fixed place of business in the US, you can actually have a permanent establishment. So, the thought process here, I just want you to think is that, going from that low threshold of, I have a US trader business, I'm likely doing a business in the US, to a permanent establishment. It is a sliding scale. It's not based on, here's how much revenue I'm making in the US, here's the scale of the, revenue I'm earning from the US. It's more looking at your overall US activity. And as your U.S. activity grows, and we're seeing this, where you have, more travel because you need people to go down to the U.S. to close deals or just scope out who are the customers or vendors, or you have people crossing the borders or making more, local U.S. involvement with contracts, negotiating. That's where the sliding scale goes from, well, you had a U.S. trader business and now you have a permanent establishment. And once you have a U.S. permanent establishment, that's when your U.S. business profits become taxable at the U.S. federal level, to the IRS. And how do you manage this? Well, if you're a Canadian company, and we're going to go into structuring here in a little bit, but if you have a Canadian company and you now have a U.S. permanent establishment, you want to be able to manage your taxes so you're not double taxed. And that's why we rely on foreign tax credits. And the foreign tax credits are great, assuming you have the right structure, because you want to make sure that, the income type that you have and the type of structure you have will allow for the timing match to be eligible to use the foreign tax credits in both Canada and the US.
And
And
one thing I'd like to add, Namir, is the concept of ECI. We had a client that came in and said, we have a problem. We went to a Canadian CPA and we said, we've got this US branch. So we have effectively connected income in the US. The CPA said, are you making any money? And they said, no, we're not. And he said, you don't have to worry. You don't have to file anything. You don't have to file an income tax return, is what he told them. But the problem with the US, there's more than just an income tax return. There's also what's called informational returns. So in the concept of this US branch, there's a form, it's called 5472, where you're filing and reporting in respect of 25% or more specified shareholder, that's foreign. And the penalty for late filing a 5472 is now $25,000 US. These guys had 10 years of
oh my
missed
gosh.
filing. So it was an automatic $250,000 US penalty. So it's not just about income tax returns, it's also about the informational reporting that's required. And it can be very problematic. So make sure you're getting proper advice in respect of what your situation is so that you don't get these surprises.
Yeah, that's a really good point. And the interesting thing about, those 5472s is one other flag that I see often is even when you have, like, sometimes you'll have a Canadian who got advice to set up their structure in the US as an LLC. And in their mind, oh, the LLC doesn't have a lot of activity happening in it. All I've done is maybe inject some capital. I've capitalized that LLC. And the challenge you have with that is there's still a 5472 filing obligation. And those penalties that you get from the IRS, and besides it being, a pretty scary notice, they're automatic. So the IRS, as soon as it sees that you haven't filed the return or you are late in filing it, those 5472 obligations, even though in your mind as a Canadian business owner, it is a shell of a business, there's nothing happening in the US. It's in your mind a disregarded entity. Everything is happening in Canada. I haven't even done a related party transaction other than just, capitalizing my LLC. Those $25,000 penalties are automatic, and you're going to get an IRS notice, and you're going to have to deal with following up with the IRS to, find ways if you can abate or mitigate those penalties.
And previously, a taxpayer had the ability to file a reasonable cause argument in respect to those penalties. But effectively, I think what's happened is, and you can comment on this, Namir, I think what's happened is the IRS has basically said, if you want to file a reasonable cause argument, go to the U.S. tax court and deal with that. There, it's far more expensive than paying the penalty.
Yeah, pleading ignorance is not a reasonable cause.
Oh,
Yeah, it's and there are ways to go back to the IRS and challenge these, but at the end of the day, the $25,000 penalty, once you get that notice, it is automatic. It's not even you're dealing with an IRS agent yet. It's just the IRS knows immediately this is delinquent and there's a requirement to pay and file. And with that, we're going to jump into our first polling question.
so the first question is, at what point, sorry, I just have to move this as my way. Sorry, at what point do you believe a Canadian business becomes subject to US taxation? So A, only after incorporating a US entity. B, once employees or an office are established in the US. C, when business activity creates a US trade or business. And D, only when a permanent establishment exists under the treaty. So that's a good question. Obviously, only one answer is the most correct answer. So you've got what, a minute to submit your answer?
Yeah, and the reason this is a good question is a lot of times what I find is when Canadian companies are talking to us about, their US activity or their US presence, they're a bit surprised and say, "Well, I have actually no permanent presence in the US. Like I don't have necessarily an office, a brick and mortar store. We haven't established a US entity. Why is my Canadian company that is doing work in Canada that has revenue from US customers, being subject to US tax at all?" They'll tell me I don't have a permanent, they'll do it, sometimes for lack of better words, ChatGPT answer of I'm not permanent in the US. But that's not the question here. It's more, do you have that lower threshold of a US trader business that says you're subject to tax? Looks like most people got that answer correct. It is when your business activity creates a US trader business. Answer C.
So next we'll talk about taxation of Canadian individuals. There's a variety of topics here to discuss. And again, this is based on carrying on a business in the United States. It's either through domestic legislation, and SPT is an acronym for Substantial Presence Test, and we'll talk about that in a second, or it's under a treaty position. And when we're talking about treaty, we should also mention that treaty generally, not generally, but it applies to federal taxation and not necessarily to all states. For example, California does not recognize the Canada-US tax treaty. So you have to look at things differently when you're dealing with a state, a specific state. And unfortunately, there's 50 of them, and each state has different legislation. So, for example, if we're talking about California, as I just did, if you're carrying on a business in California, you could be subject to California state taxation, even though you don't have a permanent establishment for federal tax purposes. I should speak about SPT. SPT is one of the things in the Internal Revenue Code where if you're deemed to be substantially present in the U.S., if you meet that test, and it's a formulaic calculation, number of days in the current year, 1/3 of the prior year, 1/6 the year prior to that. If that number aggregates 183 or more, you're deemed to be substantially present in the U.S. Therefore, you are considered a U.S. tax person for all things U.S. tax, including some of the forms that are required to be filed, FBARs, foreign bank account reporting, all of those types of things. But then you do have the ability to tie break to Canada, but you have to be in the treaty to tie break to Canada, and I'll get to that in a second. So the treaty, as I said, when we're looking at Article 4, that's where we determine residence. Article 5 is PE, and if you aren't deemed to have a PE under Article 5, then Article 7 reads that any business profits are taxed in the country of residence and not where you're providing that service because you don't have a PE. Onto sourcing rules, as Namir mentioned, these are very important because sourcing rules, what that does is two things essentially. First of all, it determines what taxing jurisdiction has the first right of taxation on that income. So if it's sourced from the US, the IRS has the first right to tax. Then the second thing that's important with the sourcing rules is looking at which taxing jurisdiction then provides a foreign tax credit. So if it's sourced in the US, then Canada will provide a foreign tax credit. But when we're looking at Canadian foreign tax credits, which I'll talk about in a minute, they're restricted to the extent of the Canadian tax legislation. Immigration requirements, again, federal tax, and this is a concept that a lot of people don't understand. Federal tax is different than US immigration. So under federal tax rules, as I mentioned, we've got the 183-day test. Under immigration rules, we have a 180-day test. So it's different. And just because things are done for tax purposes doesn't mean that they align for immigration purposes. So you can't confuse the two different sets of legislation, and you have to make sure you're aligned with both sets of legislation.
Just gonna add
we
to that,
talked about,
Dale.
yeah, sorry, go ahead.
Oh, I was just going to add to that too. One of the comments I hear you always letting clients know as well, and not only that the immigration and tax rules are different, but it's really critical for businesses and individuals that are traveling to the U.S. that they have a really good job tracking system where they're really tracking the number of days that they're in the U.S. It needs to be really tracked on a day-by-day basis. This is critical information, and it's not, just because you're on side from an immigration perspective, you're not necessarily on side from tax. And it's not just that 1 year. You're looking back at it's a 3-year rolling period.
Correct. That's right. And you can access an I-94. If you go to the I-94 website and enter in your passport number, you should be able to get the days that you were in the US and or Canada based on your I-94. But remember, that's not a perfect uh, solution. You should be tracking your days. And even a partial day is considered a day when we're looking at this. And there's some exceptions to what doesn't constitute a day if you're ill and that sort of thing and you're not able to travel. So you have to really look at the day count requirements to make sure whether you're looking at SPT or if you're looking at immigration. One thing that we should talk about is Canada taxes an individual based on residency. And that's a factual resident or a deemed resident. You can be deemed to be a resident of Canada if you're sojourning in Canada, or if you did not factually depart Canada because you maybe one spouse left and the other spouse and family, stayed in Canada. That would not constitute a factual departure in the eyes of the CRA. The US, on the other hand, taxes based on residency, factual or deemed being SPT. But it also is one of the few countries in the world, I think there's two, that tax based on citizenship. So you can be a US citizen, and no matter where you reside, you're still taxed on your worldwide income. So a Canadian resident uh, who's a US citizen is not, they're taxed on their worldwide income because they're a resident of Canada, but because they're a US citizen, they're also taxed in the US on their worldwide income. That's where the foreign tax credit regime comes in. That's where we're looking at sourcing, and that's where we have to, do the dual tax return, if you will. The problem with having a U.S. tax return in 1040, which is equivalent to a T1, a 1040 is due April 15th. You can get an extension. The U.S. allows extensions, but it's due April 15th. A Canadian T1 is due April 30th. So if we have a US citizen resident in Canada who's receiving K1 type of income, K1's equivalent to a T5013, so you're getting an allocation from a partnership. Generally what happens is those K1s aren't available to timely file the US return. So either you put an estimate on your Canadian return so you can file by April 30th, or you don't put anything on the Canadian return and amend. We recently had a client where we put an estimate for the K1 on the Canadian T1, and unfortunately, the estimate was based on prior year. When the actual K1 came in, it was significantly lower than what the estimate of income was, which unfortunately triggered an audit by CRA. They're wondering how the heck can you have that much lower of income? And we're talking, lots of dollars here, lots of zeros, and it triggered an audit, and we just have to deal with it. So there's filing problems when you have U.S. citizens that are resident, in this case, in Canada. Tiebreaker rules contained in the treaty. So as I mentioned, Article 4, you can go look at residency and you can follow the rules. They're in order of priority about your ability to tiebreak back to Canada, for example. But what's really, really important is you must be in the treaty to rely on the treaty. And what I mean by that is you would have to be deemed to be a resident of the US, for example, under the substantial presence test, and also a factual resident of Canada. You can't say, well, I'm going to rely on the treaty if you're not in the treaty in respect of both taxing jurisdictions. So there's too many practitioners will say, oh, well, we'll just rely on the treaty. But if you're not in the treaty, you can't do so. if you are relying on the treaty, it's very, very important to file a treaty-based position with respect to that taxing jurisdiction. So, for example, we could have a Canadian corporation that doesn't have a PE in the US. We file an 1120-F. 1120 is equivalent to a T2. Dash F means foreign. So it's basically a nil return, but you have to disclose on Form 8833 to the IRS that these are the treaty positions I'm relying on, and here's the quantum of US sourced income that I'm taking a treaty position in respect of. So generally, the 8833 would be I'm relying on Article 5 because I don't have a PE, and therefore I'm relying on Article 7 because business profits are now taxed in Canada. But you have to file that 1120-F. Just saying that I meet the tests in the treaty or the requirements of the treaty is not sufficient. Foreign tax credits, again, sourcing becomes important, and then which jurisdiction is going to provide the foreign tax credit. In Canada, the foreign tax credit is the lesser of the actual foreign taxes paid or the Canadian tax otherwise payable. And too many people just think, well, I'll put the foreign tax credit on my return, but if there's no Canadian tax otherwise payable in respect of that, so say, for example, you have a US citizen resident in Canada who receives a capital dividend, which not a good thing, but they receive a capital dividend which is not taxable in Canada as an individual shareholder, but it's taxable in the US because there's no concept of capital dividend in the US. So the US return will be prepared, the 1040, taxes are paid, and unfortunately, some Canadian practitioners will just pick up that foreign tax credit and put it on the Canadian return, even though the Canadian tax payable, otherwise payable, is zero. As I'm sure all of us in this audience know, CRA follows up on foreign tax credits and looks for supporting documentation to make sure that the foreign tax credit claimed is accurate and appropriately supportable.
And a couple of notes on that, Dale. You mentioned the 1120-F. Even when you have a Canadian entity that is filing that return in the U.S. and they're thinking, well, I've established that I don't have a U.S. permanent establishment, so I'm not going to be taxed on my income in the U.S. And sometimes we've heard business owners say, well, I think I'm going to take the decision of just not filing that return at all because it seems like it's pretty low risk. And
Right.
the risk you run there is if you do not file anything at all with the IRS, because in your mind, again, it's going to be a contingent on their risk profile. What you're doing there is you're actually exposing the Canadian entity where the IRS will say, if you haven't filed that 1120, you have that treaty protected return. What you're doing there is you're actually denying your ability to potentially take any deductions on your gross income. So if you have gross revenue in the US, by filing that 1120-F protective return, you're ensuring that you're able to take any deductions, expenses against that revenue, should the IRS come back and challenge you on that permanent establishment position. So it's essentially saying, hey, this is the position we're taking, that there's no permanent establishment. And should the IRS challenge it, you'll still be able to take those deductions because you filed the return. But if you do not file it, then you essentially lose that privilege or that ability to take those deductions against your gross income by not filing at all. And I think fun-based trivia, I think the only other country that has citizenship-based taxation besides the US, I think is Eritrea. I believe that's correct. All right. So with that, we'll jump into probably one of the most important decision points for Canadian businesses as they march into having a U.S. establishment and they say, well, we know we have a U.S. trader business. We'd like to set up an entity. What's the right entity structure? And, I have to say, structure problems, the structure question, because we talked about exposure, we talked about sourcing, we talked about treaty protection. All of that's going to flow through your structure. So your structure problems, if you don't plan correctly and early, these will show up later as tax problems. And you really want to be sure that you're picking the right structure because this is going to shape your liability. This will, your tax bill, your ability to then take some of the profits from the U.S. back home, and even your long-term exit options. So often when we're having these very early conversations with founders about, what is your business? What are you looking to do in the US? We're already having the conversations about, well, what are your long-term exit options as a founder? What are you looking to do as kind of your final exit strategy? And the reason this matters is, look, Canada and the US, we don't always agree, not on hockey and not often on how to tax your business. So if you've got the wrong structure, you might end up with double tax, you might lose your tax credits, you might have some personal liability on business debts. But if you've got the right structure, you can manage your risk, you can optimize your tax position, and keep your cross-border operations running smoothly and focusing on growing your business. We'll talk about some of these business structures here. So general partnership, that's a pretty easy one to set up. That doesn't really require any formal filing. Setup costs are minimal. The challenge you have with the general partnership is, every partner in that partnership is personally liable for all debts and obligations of the business. So if something goes wrong in the U.S., your company's your Canadian company's assets, or even like, for example, your personal assets, if you're an individual partner, they're on the line. So big risk, especially if you're in the U.S. legal environment. But the GP is a flow-through entity for both U.S. and Canada. So the partnership itself, it doesn't pay tax, but the profits and losses will flow up to the partners who report them on their own tax return. Again, this is efficient if you're going to be filing the U.S. tax returns as a partner, but again, general partnership generally not advised, not very practical. It's a non-starter generally for U.S. expansion because of the unlimited liability, but could be an option if you have low-risk projects or like a short-term joint ventureship, but rarely for a serious U.S. market entry. Limited partnerships, these are a bit more complex. This introduces two classes of partners. So you've got general partners who have, they're the ones managing the business. They have unlimited liability. Typically, this is set up as a corporation, again, to limit the liability to an individual partner. And then limited partners, they will be the passive investors. And so their liability is limited to their investment. This is a bit more work than a GP. It is pretty straightforward. But again, that general partner faces unlimited liability. In practice, where we see limited partnerships, they tend to be in investment projects or also joint ventureships, especially where you have passive investors involved. But again, if you have an operating business, the need for a general partner can be a reason not to look at a limited partnership. And then you've got this, hybrid structure. You may have seen these in the US. They're also pretty popular. It's a LLLP. There's also a double four LLLPs. So what the LLP is, a limited liability partnership, is it's a variation of the limited partnership. It's available in some U.S. states. And here, both the general partners and the limited partners will enjoy limited liability protection. Not all states recognize this, and more critically, from a Canadian lens, this is treated as a hybrid entity. So what that means is it's a flow through in the US, but in Canada, it's treated as a corporation. And so this can result in a misalignment of the taxpayer identity and your ability to claim some of those foreign tax credits that Dale just walked us through. Then you've got limited liability companies. Now, limited liability companies, I will say these are the darlings of U.S. entrepreneurs. They're very popular hybrid vehicles in the U.S. And the reason for that is they're very easy to set up. They're quite flexible. They offer limited liability, credit protection to all the members. So members are protected from personal liability, just like shareholders in a corporation. Similar, you're filing an article of organization with the state. You have to draft an operating agreement, and you're in business. Sounds great. The problem with it is often what happens with a limited liability company is, you go to a U.S. advisor and they'll tell you absolutely go with a limited liability company. But as a hybrid entity, which is what a limited liability company can be, is it can be treated as a flow through, so either as a partnership or a disregard entity, which is driven by the number of owners you have, or if you file an election. Whereas in Canada, this can be treated as a corporation, not a flow through, not a partnership, not a disregard entity. So this creates a classic tax mismatch, right? So the U.S. taxes the members directly, but then Canada sees this as a separate taxpayer. And so the result could be, again, if this is not planned correctly, or if you don't have the right elections in place, or you don't have an indirect ownership instead, you'll end up paying taxes in both countries on the same income with no foreign tax credit relief. Again, this is probably one of the most common. I think Dale, you probably see this quite regularly. Costly mistakes with
Yeah.
Canadian businesses expanding into the U.S.
Yeah, and if you think of it, Namir, if you have more than one member in the LLC, as you said, it's taxed as or treated as a partnership for U.S. purposes. So it's a partnership for U.S. purposes. It's a corporation for Canadian purposes. So what we'll have for U.S. purposes is that the partnership allocates income to the partners, and if they're Canadian resident partners, they're going to be picking up that income on their tax return, whether it's a corporation or an individual. That's an allocation of income. Whereas if we have from the Canadian lens, the only tax there's going to be is on distributions, not allocation of income, but distributions from the LLC, which CRA will treat as a dividend. Now the issue is, let's say in year one we had an allocation of income. Year two, there's no income to allocate, but there's a distribution. So because CRA looks at that distribution as a dividend, there should have been a tax withheld and remitted, which likely was not done. So we end up with all of these issues with, is it an income or is it a distribution? And when is it taxable? And who's the taxpayer? And the ability to claim foreign tax credits. Because if we had individuals as partners, they're picking that up on their personal tax returns. Whereas if it's a corporation, then we've got dividend income and two separate taxpayers, and it just causes all kinds of problems. So that's why we recommend direct ownership by Canadian residents is not recommended. However, you can, in sort of a perfect world, if you can structure the timing of the allocation of income and the distribution in the same taxation year in the same amount, you may be able to make it work a little bit better. But again, you'd want to have the member being a corporation so that it's also receiving that dividend. So it's just not a recommended investment vehicle.
That's right. You could structure around that mismatch to your point there, Dale. And the last one there, just the USC corporation. These what a C corp offers in the U.S. is, the shareholders will enjoy full limited liability protection. Really from a practical consideration here, this is pretty clean. It's pretty predictable. You're harmonizing the treatment in the U.S. and Canada. The main downside really with the USC corporation is, there is potential for double taxation because it's not a flow through. And what I mean by that is you're getting taxed at the corporate level and then again at the shareholder level. So you just need to make sure if you're going down the C corp route in the US that you've got proper planning, such as how you're timing your dividends, your management fees, and leveraging treaty benefits. So we'll go into how to repatriate your profits next. But just, again, the takeaway I just give our audience here is there really isn't any one size fits all answer. The choice of your entity, though, is a pretty critical question, and it is really foundational to your U.S. expansion. ChatGPT is not your friend. If you're going to get an answer, you spend a lot more time and energy and cost fixing the wrong answer. And look, if you're a Canadian business looking to expand into the U.S., especially in tech, or if you have a software as a service company or a fast-growing sector, get that expert advice early. Map out your goals. It's not a one variable equation. What is your risk tolerance and your long-term plans? And the best structure you're going to get, we get this question often, well, what's my best structure? Well, the best structure is the one that's going to fit your business, aligns with your tax treatment, keeps you focused on growth, and answer some of the questions at the founder level. Are you planning to move to a sunnier destination sometime later as as you grow the business or maybe you exit your business? So think about these questions early as early as you can. And with that, we're going to question number
Just a
two.
second before
Oh,
we jump to
sure.
that, if you can back up a second, please, Namir. So one thing I want to add is because you're talking about tech sector and AI and things like that, perhaps. In Canada, we have a CCP concept of a CCPC and the ability to claim a lifetime capital gains exemption if those shares qualify as a small business corporation. The US has a concept that's similar. It's a qualifying small business stock,
Corporation.
and basically it has to be a C corp for QSBS treatment. You have to hold that stock for 5 years, and there's certain industries that are eligible for QSBS type of treatment, but the benefit of it is the ability to claim $15 million of a capital gain is exempt on an annual basis in respect to the sale of that QSBS. So there's things that you need to consider and plan for because if have the ability to sell those shares later on, and one, it wasn't a C corp, and two, you didn't hold it for 5 years, well, you just blew the ability to do QSBS type of treatment. So planning is very important as Namir said, at the early stages.
Yeah, and you're talking exit strategy with founders as they're talking about how to start their business and scale their business and grow their business. But these
Right.
are why these questions matter. You really have to have a long range scope of view for where you're going to be, not only as a business, but also shareholders. What are your motivations? What are your kind of long-term strategies for you and the business? And with that, Dale, we're going to jump into our poll question number two.
Please. So question number two, which of the following structures is generally not recommended for direct use by Canadian businesses expanding into the U.S. due to cross-border tax mismatches? A, U.S. C corporation, B, limited partnership, C, limited liability company held directly by a Canadian parent, or D, general partnership.
Yeah, this again, like I said, this comes up pretty often for us, Dale, in our business, in that we see companies are often asking us to clean up after they realize that they've gone through what was otherwise good sound tax advice for a U.S. Client in the U.S. to set up a LLC, but the concern you have is which of these structures, I'm not giving you the answer, which of these answers may take away the relief that you get for double taxation, your ability to use foreign tax credits, and that's a critical piece of the cross-border structure question. Which one you choose will have an impact. Again, assuming this is a business that's earning revenue as a cross-border structure. And with that, looks like most people got our answer correct. It is letter C, limited liability company held directly by a Canadian parent. And the word directly matters because, again, there are ways to structure this to manage that mismatch as a hybrid entity. With that, we're going to talk about now, Dale's going to jump us into ways to repatriate your U.S. profits back to Canada.
Yeah, so great. You set up a U.S. business, becomes very successful. Let's assume it's a U.S. C corp. Then how do we repatriate those profits back to Canada? So there's generally three types of methods to repatriate those profits. One is management fees, and we need to consider transfer pricing and the ability to have contemporaneous documentation. So if we have a CanCo with a U.S. subsidiary, we can do a management fee, but it's important to remember that one, the management fee must be reasonable because of transfer pricing, and transfer pricing in respect of both taxing jurisdictions. And also, I always am a firm believer that if we've got a CanCo, there needs to be a Canadian employee in that company, because if there is no employee, who's providing the management services to the U.S. sub? So we need to make sure that we have Canadian employees that have the ability to provide these services, and then we can repatriate the management fees. Caution that there's certain things that we have to watch for in the FAPI regime, but that's beyond the scope of this presentation. Dividends is very popular. They're subject to a withholding tax. Canada has surplus pools. So Namir spoke about earnings and profits, which is tax retained earnings in the U.S. And Canada has a similar concept. There's exempt surplus, hybrid surplus, taxable surplus, and pre-acquisition surplus. Regulation 5900 has rules in respect of exempt, taxable, and pre-ac dividends. Regulation 5901 is the ordering of the surplus distributions, but generally we pay an exempt surplus to the extent that there's E&P earned from active business income. Any excess distribution would perhaps fall in the hybrid, and then next would be taxable and then pre-acquisition. So it's important to note that not only the IRS wants an E&P calculation in place prior to a distribution, CRA wants an exempt surplus calculation, if you will, prior to an exempt surplus being received from that U.S. subsidiary. And that exempt surplus dividend, you can follow through in subsection 113(1) of the Income Tax Act and just see how it's taxed for Canadian tax purposes. But if it's a corporate to corporate dividend, it's subject to a 5% withholding tax to the IRS, and that has to be remitted on a timely basis. That tax is not recoverable in Canada, so we do have a bit of tax leakage because the exempt surplus dividend is not taxable in Canada to that Canadian corporation. As I said previously, foreign tax is the lesser of foreign taxes paid or Canadian tax otherwise payable. Because CTOP is zero, we have tax leakage of the 5%. So it's just one of the things that you need to be mindful of. The other is intercompany debt. Um, in Canada, we have lots of intercompany debt without an element of interest on that debt. There's rules in respect of 21C. If we borrow money to advance, then we have to have some form of earning income on that debt. But generally, a lot of the Canadian corporations is done on without interest. In the U.S., if there's no intercorporate interest on that debt, then the IRS has the ability to recharacterize that debt as equity. And specifically, if it's not properly documented that it is debt, we don't have interest on respect to that debt. And then Namir will talk to this a bit about the ability to deduct that interest by what the U.S. sub would be paying up to Canada. So there's definitely rules when we're dealing with foreign corporations in the United States.
That's right, Dalia. I mean, really, what the IRS is trying to do there with intercompany debt is, the IRS wants to know that the loan is actually, a genuine loan. You've got a written agreement, you've got regular payments, and if you're charging an unreasonably low interest rate or no interest rate at all, it can recharacterize that debt as equity. And, the challenge there is if, that does get recharacterized as equity, how you're repatriating that back to Canada can have an impact on the denial of interest deduction, withholding that happens if it's now treated as a dividend versus an interest payment. The only thing I'll just add here, just kind of just in the interest of time, when you're thinking about intercompany debt and you're comparing, a Canadian borrower versus, a U.S. borrower, with a Canadian borrower, they're looking at, do you have too much debt and too little equity? You've got that 1.5 ratio for debt to equity look at from a Canadian borrower's perspective. From a U.S. borrower's perspective, they're looking at one, are you a small U.S. taxpayer? And I think in 2025, that's like a $31 million average receipts that they look at over the last 3 years. And, if you're below that, you don't have to worry about the U.S.'s, equivalent of business interest deductibility rules. But if you are, then essentially the interest expense that you're able to deduct as a U.S. borrower, as a U.S. company, that's going to be capped at 30% of your adjusted taxable income. And so just make sure if you've got this, you're looking at careful structuring, how you're financing this, whether it's through debt or equity, and you're documenting this to make sure you're preserving your tax efficiency and hopefully avoiding any surprises. Well, oops, sorry. And then the next thing I want to chat about here is state taxes. And the reason this matters is you're not just dealing with the US federal taxes at the IRS's level, you're also dealing with not only 50 states, but you're also dealing with the local jurisdictions. It could be at the county level, it could be at a city level. So there are a lot more jurisdictions to be dealing with below the federal level. And this is an often underestimated risk for Canadians. They expand in the U.S., they have their federal exposure managed, but they do forget about the state and local tax, which is one of the main reasons we often see with, a lot of M&A work that we do or due diligences. This is one of the main reasons why those due diligences can fail. It's a major exposure area. And the reason for that is we talked earlier about permanent establishment, and that's a federal U.S. IRS tax concept, whereas states have a much lower bar for what subjects you to tax, and that lower threshold is what's known as nexus. So that's kind of the minimum amount of connection you need to have with a state for them to have the right to tax you. Previously it used to be this concept of physical presence. That's kind of a traditional trigger. If you have an office in the state, if you have an inventory in the state, you have a warehouse in the state, or employee working from that state, you probably have nexus in that state. But again, the economics of how businesses are transacting and generating revenue, remotely is different than as it was 20 or 30 years ago. And so we have this concept of economic nexus, and there's different variations of this. But essentially, what you need to know, and kind of going back to our tech sector and e-commerce and software as a service company, this is why this matters. Excuse me, this is why this matters because it's looking at not physical presence, but it's looking at your overall economic activity without having any physical presence required in that state. And so this could be triggered if you have, exceeded a certain sales revenue in a state. So that could be, for example, you're over $100,000 or you have more than 100 transactions. So you could be sitting in Toronto selling your software to customers in California and New York, never having set foot in the United States. And maybe you don't even have a U.S. permanent establishment. So you're not subject to taxes at the IRS level, but you'll find that you're going to have filing obligations in those states. So California, as an example, California actually goes out of its way to say they don't adopt the U.S.-Canada treaty. So it will not offer you that protection. So you're saying none of my income is taxed in California. And and I just want to remind you that in the US, it's not just looking at corporate income tax, which is the tax on your net profits, but you have to look at a whole variety of different taxes. You've got, sales and use tax. And, this is a pretty critical and complex area for, tech companies or software as a service company because states have wildly different rules on whether, again, the characterization of that income, whether software or a digital service or a subscription is even taxable. And failing to collect and remit sales taxes can be not only a significant tax liability, but you could become personally liable for that uncollected tax. And again, a lot of our tech company clients, they're looking at kind of the big picture, the exit strategy in the long game. And, from a due diligence perspective, you don't want to miss this. Then you also have payroll taxes. Again, if you have U.S. employees, franchise taxes. This is taxes that are based not on income, but more on your overall net worth or capital. Another one that tends to surprise our Canadian clients. So, just make sure takeaway, state tax, it's not an afterthought. It really should be a foundational part of your U.S. expansion strategy. And with that, we're going to go to our final polling question.
So our last question is, which of the following methods of repatriation is subject to a withholding tax under the treaty? A, management fees, B, dividends, C, interest on debt, or D, all of the above.
So, Dale, I think part of your takeaway here earlier was that there are a lot of levers available for how to repatriate profits out of a U.S. structure back home to Canada.
That's correct. And there can be, you can do a combination of those three that I mentioned. It doesn't have to be just one. It has to depend on, the structure of your business, the nature of what you're doing, where the income is. The days of shifting profit from the U.S., corporate profits from the U.S. up to Canada, those are over because, U.S. corporate tax federally is not at 35% anymore. It's at 21. And if you're looking at various provincial rates, like in Alberta, for example, the general rate is 23. So it's really a push. So it's not about shifting profits, which is not appropriate from a transfer pricing perspective, but it's about what makes sense to the entity, what might make sense to, for example, if it's dividends and we flow those through out to the ultimate shareholder, we have to look at one, we're losing that 5%, but then how are those dividends being, pushed out to the ultimate shareholder of the CanCo or Holdcos, whatever it may be.
That's right. And looks like got some good answers here. Are looking at all of the above on the poll question there, number 3. All right. So, we're here on the near end of our hour here. So I just want to ask if you could also please kindly fill out the survey that you'll get at the end of this. Tell us how can we improve and any topics you'd like to see us covering. We are going to stay for a couple of questions. I'm going to go into, see, I think we've got one here, pulling it up. We are a Canadian tech company. We have no U.S. office, but we have $250,000 in annual sales, and we've hired a remote salesperson in California. What are the U.S. Federal and state filing obligations? I think, just big picture here, you just want to think about, if you're hiring a salesperson in California, that is going to establish likely a U.S. shared business. So that automatically is going to trigger for you a mandatory 1120 filing. That's 1120F for income tax return of a foreign corporation. And whether just because you have a filing duty, your actual tax liability is going to be governed by, as we talked about, the U.S.-Canada Treaty. So whether you have a permanent establishment, and that's something that has to be reviewed as a facts and circumstances test. From a state perspective, again, remember the Canada-U.S. tax treaty in California is not adopted, so there is that lower threshold of having nexus. And that's, tells you whether California has the ability to assert its right to tax you. And if you have an employee, I believe you said you have an employee sitting in California, that will create a definitive physical presence nexus. So that'll mean, you have to register in California. You're going to be subject to California corporate income taxes, likely sales tax on your revenue, and also state payroll taxes.
And one thing to add is once you're in the state of California, one, doing business, so you're registered to do business, but then they expect you to file a California state tax return. But once you're in there, it's hard to get out.
That's right. Yeah, you'll have to actually file for a withdrawal from the state once you
Yeah.
decide you're no longer doing business in California. Okay, I'm looking here at the time. We're right here at the top of the hour it's been 10 o'clock here in Vancouver. Before we wrap up, I just want to say, I want to personally invite you to continue the conversation with us at Web Summit Vancouver. I'll be there all week with many of my colleagues, and we're hosting a hands-on masterclass. We'll also be spending time at our booth talking with founders, operators, tech leaders about what really matters, in this intersection of tax and technology. So whether you want to stop by for a quick, 15-minute consultation, there's a QR code there, attend the masterclass, or just book a time to meet with any of our senior team leaders, or just talk through your specific challenges. We'd genuinely love to meet you. If today my conversation with Dale sparked any questions or ideas, Web Summit is just one avenue for us to take that next step. We're really looking forward to being there and to meet you in person. And with that, Dale, thank you for your time. This was a fun hour.
Yeah, thank you, Namir, and thanks to everyone who participated. Bye.
Bye.